So if you pry open, like, a cutting-edge AI server today.
Or even an EV, right?
Yeah, exactly, an EV. If you completely tear it down to the bare chassis, you're going to find this incredibly complex, totally invisible network of components just, keeping the entire system alive.
And I think the craziest part is who actually makes those components.
Right, because it's not some trendy Silicon Valley startup. They were built by the exact same company that manufactured, like, the blank mixtape cassette you probably gave your high school crush.
I mean, it really is one of the most drastic corporate evolutions in modern tech history. It's a company completely rewiring its own DNA to survive.
Welcome to the Japan Stock Podcast. Today, we're tearing up that nostalgic image of the 1980s cassette tape.
Yeah, we're going way past the analog era today.
Exactly. Our mission on this deep dive is to really unpack the massive, transformation-driven machinery of TDK Corporation.
And we're going to be looking under the hood of their global operations, right?
We are, and we'll be relying heavily on the hard financial and strategic data they just published in early June 2026.
Which is super revealing, because if you want to understand how the modern global tech supply chain actually functions.
Or, if you're just looking at where your portfolio is really exposed.
Right. You absolutely have to understand who is manufacturing the bedrock architecture of the digital world.
So let's just start with a basic reality check here. What is TDK actually doing today? Like, what's the true identity driving the revenue right now?
Well, to put it in perspective, their business structure is basically divided into four main segments.
Okay, lay them out for us.
So you have passive components and then sensor application products.
Right, the microscopic sensors.
Exactly. Then there's magnetic application products, which covers things like hard disk drive heads. And finally, energy application products.
Which is their battery division.
Yeah, but you really have to apply the classic 80-20 rule here.
Yeah.
I mean, you can't just look at these four segments as equal pillars.
Right, because some engines are clearly pulling way more weight than the others.
Oh, absolutely. The energy and ICT-related components are the undeniable, massive engines of this entire operation.
Just dominating the balance sheet.
Yeah, the sheer scale of the energy segment alone is staggering. I mean, TDK's small and medium secondary batteries form the absolute bedrock of their profitability.
Driven mostly by their Hong Kong-based subsidiary, ATL, right?
Exactly. ATL is huge for them.
And we should probably clarify what we mean by secondary batteries, just for anyone picturing, the AA batteries in their TV remote.
Right, yeah, we're not talking about those.
We're talking about rechargeable lithium-ion cells. The super high-density power sources that go into smartphones, laptops, and increasingly mobility devices.
Which is why I like the analogy you use for this.
Oh, the human body one. Yeah. So think about a modern smartphone or a cutting-edge EV as a human body. TDK isn't the flashy brain, right?
They're not designing the CPU that does the thinking.
Exactly. And they certainly aren't the face. Like, they don't make the shiny OLED screen you're staring at all day.
So what are they in this analogy?
TDK is the invisible nervous system, providing all those microscopic motion and temperature sensors. And crucially, they're the cellular metabolism.
Providing the secondary batteries that regulate power and just, keep the entire organism alive.
Right, because without the nervous system and the metabolism, that brain and that face are what?
They're nothing but really expensive glass and silicon paperweights.
Exactly.
And being the metabolism of the tech sector, I mean, that puts you in a highly lucrative, highly defensive position in the value chain.
Which honestly makes their origin story even wilder. Because knowing that TDK makes the nervous system today leads right into how they actually built this portfolio.
The whole cassette tape pivot.
Yeah. How does a company famous for magnetic analog audio tape survive the digital revolution and become a battery and sensor titan?
Well, they basically saw the cliff approaching as analog media entered its death spiral.
Right. No one was buying tapes anymore.
Right. But rather than just slowly fading into obsolescence, they weaponized the cash generated from that legacy tape business to aggressively acquire future technology.
They went on a buying spree.
A very calculated one. In 2005, they made a massive move to acquire ATL.
Which gave them the foundational tech for secondary batteries, right?
Exactly. And right before the global smartphone boom exploded.
Yeah.
I mean, the timing was perfect. Later, they bought InvenSense to dominate the microsensor market.
Oh, wow.
They even secured a strategic collaboration with CATL, the massive Chinese battery manufacturer, to get a foothold in the large-scale EV battery space.
So they literally took the profits from a dying era and purchased their survival.
They bought their way into the future, yeah.
But wait, history is kind of littered with legacy companies that tried to buy their way out of obsolescence.
Oh, for sure. Usually ends in disaster.
Yeah. They usually end up buying a bunch of shiny tech startups, failing to integrate them, and just creating this bloated, disconnected mess.
It's like the Frankenstein monster effect.
Exactly. So how did TDK avoid that? I mean, how does making magnetic tape actually help you make an EV battery? It sounds so unrelated.
It does sound unrelated, but that actually connects directly to the core of their economic moat. They didn't just staple these newly acquired companies together.
Okay, so what did they do?
They took their historic legacy expertise and actually injected it into the new subsidiaries.
What kind of expertise?
Well, think about what a magnetic cassette tape actually is. At its core, manufacturing tape requires the ability to coat microscopic magnetic particles onto an incredibly thin plastic film.
And doing it with flawless precision, right?
Flawless precision and at a massive global scale.
And that precise material science that just transfers over.
Seamlessly. Because what really is a modern lithium-ion battery?
I mean, I guess it's a lot of thin layers.
Right. It is essentially the process of layering the microscopic chemical compounds onto incredibly thin films with flawless precision.
Oh, wow. I never thought about it like that.
Yeah, TDK took decades of proprietary coding and material science expertise from the analog era and just applied it to the chemical layering required for next-gen batteries and sensors.
And they have a term for this, right?
Yeah, they call this internalization their value creation cycle, merging deep material science roots with newly acquired software and processing tech.
Because you can't just replicate 50 years of material science trial and error overnight.
No, you really can't, no matter how much venture capital you throw at it.
That is a phenomenal pivot. They didn't abandon their past. They just found a much more lucrative surface to coat their materials onto.
Exactly.
But building this powerhouse through aggressive global M&A over the last 2 decades has created a sprawling footprint.
Very sprawling.
Does operating this massive, borderless tech machine leave them deeply exposed to the current geopolitical fault lines?
Oh, it absolutely does. That global footprint functions simultaneously as an impenetrable shield and a glaring vulnerability.
Okay, let's look at the China side of the equation first.
Right, well, TDK relies heavily on Chinese manufacturing. They have massive operations through subsidiaries like ATL, TDK Shemin, and TDK Zhuhai.
And for a lot of investors, just hearing heavy reliance on Chinese manufacturing immediately triggers a geopolitical risk alert.
For sure, the optics are tough.
Yeah.
But from an operational standpoint, that localized integration provides massive resilience, doesn't it?
Well, yeah, the production advantages are undeniable.
Right. By embedding themselves deeply into those local ecosystems, TDK benefits from highly developed supply chains.
And a huge pool of specialized engineering talent.
Exactly. Plus, immediate access to the largest consumer market in the world. They aren't just shipping parts to China. They are utilizing this incredibly efficient, highly profitable local manufacturing engine.
An engine that would take decades and hundreds of billions of dollars to replicate anywhere else.
Precisely. But, we have to look at the friction on the other side of the globe, too.
You mean the U.S. trade environment?
Yeah. Looking at their 2025 and June 2026 strategic materials, TDK explicitly issues a preemptive warning regarding uncertainty due to U.S. tariff measures.
And treating this purely as a business variable here, shifting U.S. trade policies and high-tech export restrictions present an immediate threat to their margins.
A huge threat. And a key factor here is the concept of dual-use goods.
Let's break that term down for a second for the listeners. Dual-use goods are components that have both everyday commercial applications, but also potential military applications.
Precisely. And the microscopic gyroscopes and accelerometers that TDK manufacturers are perfect examples of this.
Because they're used in totally normal things.
Right, they're used to tell your smartphone screen when to rotate.
But that exact same sensor technology is critical for stabilizing the flight path of an autonomous military drone.
Exactly. So when the U.S. government places tight export restrictions on dual-use goods to prevent them from reaching foreign military supply chains, companies like TDK get caught directly in the crossfire.
Even if they're just trying to sell sensors for consumer electronics.
Yep. The compliance, the friction, and the potential for blocked shipments just create massive operational bottlenecks.
Okay, let's run a shock scenario here. Imagine the U.S.-China tech corridor tightens even further over the next year. Just how sensitive is TDK's cost structure to that kind of macroeconomic shock?
The sensitivity is severe because you're dealing with a company highly dependent on cross-border integration and currency stability.
Right, the exchange rates.
Yeah, in the June 2026 reports, management is modeling their entire operational forecast on assumed exchange rates of 140 yen to the US dollar,
And for Europe?
155 yen to the euro. A sudden fluctuation in those rates perhaps triggered by the very geopolitical shifts and tariff wars we're discussing.
It instantly impacts their bottom line.
Instantly. If the yen suddenly strengthens significantly against the dollar due to a trade shock, the repatriated profits from their overseas operations just plummet.
Oh.
Yeah, and that happens before a single battery even leaves the factory floor.
I mean, just think about that for a second. You have this finely tuned, highly profitable global machine, but the tracks it runs on are laid directly over the most volatile geopolitical fault lines of our time.
It's a high-wire act, for sure.
So, moving from the theory of global risk to their actual performance, how did this global machine actually perform in the data they just released in June 2026?
The performance metrics they delivered are undeniably heavy-hitting.
Let's hear the numbers.
So, for the FY 2263 full-year results, total revenue hit 2,504.8 billion yen.
That's a 13.6% increase year over year, right?
Yep. And operating profit reached 272.4 billion yen, which is climbing 21.5%.
And both of those figures are all-time record highs for the corporation.
Record highs across the board.
I want to pause on that revenue figure for a second, because a 13.6% increase can sound like just another dry corporate metric.
Sure.
But going from roughly 2.2 trillion to 2.5 trillion yen means they added 300 billion yen in new top-line revenue in a single year.
Massive.
They didn't just grow, they added an entirely new revenue stream equivalent to swallowing a mid-cap technology company whole.
Right.
What specific operational engines are driving that kind of massive expansion?
Well, linking the financials back to the operational floor, this surge was propelled by robust demand in the broader ICT sector.
Specifically, those small secondary batteries and sensors we discussed.
Exactly. But the real standout, like the massive rebound, occurred in their nearline hard disk drive business.
Wait, hard drives?
Yeah, but it's critical to note that these are not the clunky desktop hard drives from 10 years ago.
Right.
This surge is entirely driven by next-generation HMR and AMR technologies.
Okay, let's translate that technical alphabet soup. HMR stands for heat-assisted magnetic recording, right?
Correct.
And AMR is microwave-assisted magnetic recording. Mechanically, this means TDK is building tiny lasers or microwave emitters directly onto the hard drive head.
Yeah, which briefly heats up or alters the magnetic surface,
allowing data to be written much, much closer together, which vastly increases the storage capacity of the physical drive.
Exactly. And the catalyst for that immense demand is the global AI ecosystem.
Ah, of course. AI.
Right. We hear constantly about the high-powered processors needed to train AI, but these massive data centers also require unfathomable amounts of high-density data storage.
And TDK is supplying the bleeding-edge magnetic heads that make those high-capacity drives possible.
Spot on. In fact, management projects that AI ecosystem demand alone will account for 15% of their total sales by FY 27.
Wow.
And they expect that specific segment to grow at 25% year over year.
So they're quietly taxing the AI boom. They aren't trying to build the next language model. They're selling the high-density storage hardware required to physically run those models.
It's the ultimate pick and shovel play.
And management is directly tying this operational surge to tangible shareholder value, aren't they?
Absolutely. They maintain a really rigorous focus on their return on invested capital,
right,
or ROIC. In the June materials, they emphasize targeting an ROIC of over 8%, and that's measured against a weighted average cost of capital, or WACC, of 7%.
And just to clarify the mechanics of that for anyone managing their own portfolio, when your return on invested capital is higher than your weighted average cost of capital, the company is generating true tangible wealth.
Precisely. They're making more money on their investments than it costs them to acquire the capital in the first place.
It's the ultimate litmus test for whether a management team is actually creating value or just, treading water.
And here they are demonstrably expanding their economic pie.
Which brings us to a highly debated topic for any retail investor looking at these numbers: capital allocation.
Always a hot topic.
With record-breaking cash flowing into the business, what is TDK's management actually doing with the money?
Well, looking at their revised capital allocation policy for the FY 25 to FY 27 period, TDK expects to generate a massive 1.33 trillion yen in operating cash flow.
1.33 trillion.
Yeah. And the way they carve up that pie tells you exactly how they view the competitive landscape.
Let's hear the breakdown.
They've earmarked 510 billion yen for capital expenditures. That's for building and upgrading their physical manufacturing facilities.
Okay, that's a big chunk.
Another 330 billion yen is allocated to strategic investments, which funds their corporate venture capital arm, TDK Ventures, to hunt for emerging tech.
Right.
And finally, 250 billion yen is slated directly for shareholder returns through dividends and buybacks.
Okay, hold on. Let's look at the optics of that split for a second.
Sure.
They're generating 1.33 trillion yen in operating cash flow, but they're only returning 250 billion to the shareholders.
Correct.
I mean, they're hoarding over 800 billion yen for capex and strategic investments. If you're an investor holding the stock, how is keeping the lion's share of the cash shareholder first?
Well, it seems disproportionate until you factor in the brutal reality of the hardware technology sector.
How so?
In this specific industry, if you underinvest in capex for even a few quarters, your economic moat completely evaporates.
Really, just a few quarters.
Yeah. I mean, TDK's entire survival strategy relies on being first to market with complex materials and microscopic processes that are incredibly difficult to manufacture at scale.
Right.
You cannot build next-generation solid-state batteries or sub-millimeter aerospace sensors in an aging factory.
That makes sense.
If management hollows out their capex budget today just to pay a higher dividend, they'll simply be out-innovated and outpriced by competitors in 3 years.
So the 510 billion yen they're spending on capex is?
It's the insurance policy that protects the 250 billion yen in shareholder returns.
That makes a lot of sense when you frame it as an insurance policy. It's just the mandatory cost of staying relevant in a ruthless, physics-bound industry.
Exactly.
But this leads us to the critical final phase of our deep dive.
Right.
We've spent a lot of time analyzing record highs, massive cash flows, and successful pivots. I want your professional prudence here.
Lay it on me.
What is the blind spot hiding in this June 2026 data? Where is the vulnerability that the market might just be ignoring?
The glaring blind spot lies in the automotive sector.
The EV market.
Yeah. Right now, the massive surge in the ICT and HDD segments we just discussed is providing immense cover. It's basically masking the current sluggishness and volatility in the automotive EV market.
Interesting.
TDK has invested massive amounts of capital into developing advanced automotive sensors and EV battery components. But if consumer demand for smartphones and laptops drops, which it historically does in cyclical patterns,
can the slower-moving, highly regulated automotive market step up to cover that revenue gap?
that's the problem. Probably not. Factor in the looming tariff uncertainties over global auto supply chains we discussed earlier, and you have a significant vulnerability hiding in plain sight behind those record-high revenue numbers.
So the rising tide of the AI boom is currently hiding the rocks in the automotive sector.
Precisely. The moment the ICT tide goes out, you immediately see who is exposed in the auto supply chain.
That is a phenomenal piece of analysis to keep an eye on.
It's definitely something to watch.
Well, we've covered incredible ground today. We've tracked TDK's meticulous journey from coding analog magnetic tape to becoming the cellular metabolism of the modern AI and EV ecosystem.
Quite a journey.
It really is. We've mapped out their integrated economic moat, weighed the heavy geopolitical risks of their borderless manufacturing network, and broken down the mechanics behind their record-breaking 2026 financials.
Yep.
But I want to leave you with one final provocative thought to mull over as you review your own portfolio's exposure.
Oh, here we go.
If global geopolitical friction completely severed the technology supply chains between the East and the West tomorrow, does a company like TDK have the internal agility to successfully rewire its massive global nervous system, or does their reliance on cross-border integration become the anchor that pulls them under?
That is the million-dollar question.
Thank you for joining us on this deep dive. Keep asking the tough questions, and we'll catch you next time on the Japan Stock Podcast.